High-frequency trading is often called market manipulation. But the evidence says otherwise. HFT narrows spreads and improves liquidity for everyone. Yet it also taxes slow traders. Let's examine the mechanics, the data, and the policy response. The public image of high-frequency trading is one of lightning-fast front-running and order flow manipulation. But academic research tells a different story. A landmark study by Brogard, Hendershot, and Reardon analyzed Nasdaq data and found that HFT actually reduces bid-ask spreads and improves market liquidity. This means that for ordinary investors, the cost of trading drops significantly. The paradox is that a practice often vilified as predatory actually benefits the broader market. The mechanism is that HFT firms compete to provide liquidity, which tightens spreads and makes it cheaper for everyone to trade. This is supported by empirical evidence showing a correlation between HFT activity and narrower spreads. The study's findings highlight the importance of looking beyond popular narratives to understand the true impact of HFT. The bid-ask spread is the difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. HFT narrows this spread by quickly matching buyers and sellers. The formula is simple: spread equals ask minus bid. When HFT firms compete, they tighten the spread, reducing the cost of immediacy for everyone else. For example, if the bid is $10 and the ask is $10.05, the spread is 5 cents. An HFT firm might step in and quote $10.02 bid and $10.03 ask, narrowing the spread to 1 cent. This benefits all traders by lowering the cost of executing a trade. The narrowing of spreads is a direct result of increased competition among liquidity providers, which HFT facilitates. But there's a darker side. HFT effectively imposes a hidden tax on slow traders. If your order isn't fast enough, you might get picked off, your limit order gets front-run, or your market order gets filled at a worse price. This isn't manipulation, it's physics. The speed of light is finite, and being closer to the exchange's servers gives you a natural advantage. Slow traders pay the price in milliseconds. For instance, if a slow trader places a limit order to buy at $10, an HFT firm might see a large sell order coming in quickly buy the stock at $10, then sell it to the slow trader at $10.01, profiting from the price movement. This is not illegal but is a consequence of speed differentials. The hidden tax is the difference between the price the slow trader would have gotten without the HFT's intervention and the price they actually get. Adverse selection occurs when one party has more information than the other. In trading, HFTs can detect order flow imbalances and trade ahead of slower participants. The cost of adverse selection is the difference between the true value of an asset and the price at which a slow trader transacts. HFT reduces this cost for the market as a whole, but it shifts the burden onto slow traders. For example, if a slow trader places a market order to buy, an HFT might infer that there is buying pressure and quickly buy the stock, driving up the price before the slow trader's order is filled. The slow trader ends up paying a higher price than the true value. This is adverse selection. HFTs are better at predicting short-term price movements, so they are less likely to be adversely selected, but slow traders are more vulnerable. Let's compare the experience of an HFT firm and a slow trader. The HFT firm has co-located servers, low latency, and sophisticated algorithms. The slow trader uses a retail broker with higher latency. In a fast-moving market, the HFT can react to news in microseconds, while the slow trader takes milliseconds. This speed difference translates into better prices for the HFT and worse prices for the slow trader. For instance, when a company announces better-than-expected earnings, the HFT can buy shares within microseconds at the old price, while the slow trader's order takes milliseconds to reach the exchange, by which time the price has already moved. The HFT profits from the price jump, while the slow trader misses out. This speed advantage is a fundamental asymmetry in the market. We can model the speed tax as the difference in execution price between a fast and a slow trader. If the fair price is P, the HFT gets P plus a small epsilon, while the slow trader gets P minus a larger delta. The speed tax is the sum of these deviations. This tax is not a fee, it's the cost of being slower in a world where speed matters. For example, If the fair price of a stock is $100, an HFT might buy at $100.01 and sell at $100.02, earning a small profit. A slow trader might buy at $100.05 and sell at $99.95, losing 10 cents per share. The speed tax is the difference between the HFT's profit and the slow trader's loss. This tax is a transfer from slow to fast traders, and it is a direct consequence of the speed differential. This chart illustrates the historical trend of bid-ask spreads on major exchanges. As HFT adoption increased, spreads narrowed significantly. The data shows a clear downward trend in spreads over the past decade, coinciding with the rise of algorithmic trading. This is the primary benefit of HFT, lower costs for all market participants. For example, in 2005, the average spread on the NYSE was about 10 cents, but by 2015, it had fallen to 2 cents. This reduction is largely attributed to HFT providing liquidity and competing on price. The chart demonstrates that HFT has had a positive impact on market efficiency, making it cheaper for investors to trade. However, this benefit comes at the cost of a hidden speed tax on slower traders, which is a trade-off that policymakers must consider. In 2026, the SEC proposed a competitive auction reform to address the inequality created by speed. The idea is to route order flow to venues that offer the best prices, not just the fastest. This acknowledges that while HFT has lowered spreads, it has also created a new form of inequality, speed inequality. The reform aims to level the playing field by making the market more competitive. For example, under the current system, an HFT firm with co-located servers can see an order and react before a slower venue can. The reform would require that orders be routed to the venue with the best price, regardless of speed. This would reduce the advantage of speed and ensure that all traders get the best possible execution. The SEC's proposal is a response to concerns that HFT has created an uneven playing field. What does this mean for you? First, HFT has made trading cheaper for everyone. Second, you might be paying a hidden speed tax if you trade frequently. Third, the SEC's reform could change how orders are executed. Fourth, understanding market microstructure helps you make better trading decisions. Finally, the debate over HFT is not about good versus evil, it's about trade-offs. For example, if you are a long-term investor who trades infrequently, the lower spreads from HFT are a clear benefit. But if you are a day trader, you might be adversely affected by the speed tax. The SEC's reform could help reduce that tax, but it might also reduce liquidity. Understanding these trade-offs is essential for making informed investment choices. HFT is not manipulation, it's a speed advantage. It reduces spreads and improves liquidity, but it taxes slow traders. The SEC's reform is a step toward fairness. As an investor, you can't beat the speed of light, but you can understand the game. In the end, the market is a complex system where speed is a currency. For example, just as a runner with a head start has an advantage, an HFT firm with faster access to the market has an edge. But this edge is not unfair, it's a natural consequence of technology. The SEC's reform aims to ensure that this edge does not come at the expense of market integrity. By understanding the mechanics of HFT, you can better navigate the market and make informed decisions. We've seen that high-frequency trading is a double-edged sword. It lowers costs but taxes the slow. The SEC's 2026 reform is a step toward fairness, but the debate is far from over. What's your take on HFT? Do you think the reform goes far enough? Let's discuss. The key takeaway is that HFT has both benefits and costs. The benefits are lower spreads and improved liquidity, which benefit all investors. The costs are the hidden speed tax on slow traders, which can be significant for active traders. The SEC's reform is an attempt to balance these trade-offs, but it remains to be seen if it will be effective. Your feedback is valuable in shaping the conversation around this important topic. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.